So interest rates and price of bonds, that's the risk we're taking up. So interest rates climb, the price of the bonds falls from 5 million to somewhere lower. So that's your long position, that's your risk that you're taking on. Okay, so you have a long position with risk. So if interest rates climb, if interest rates increase to 8% over the next year, we do a little calculation on what the value of the contract is today, or the value of your bonds. And so I'm just going to give you that number. So the value on March 14th at 8% is $4,039,640. And the value on March 13 at current 6% was the 5 million we started with. So all of this exposes you to a loss of, taking the difference between those two, 960,360. Let me catch you up and see if there's any questions. Kind of tracking with the logic here, what's going on? We're holding on to bonds, we got interest rate risk. If this happens, we stand to lose 960,000 bucks. Okay, so, yeah. Yeah, I might come back to that. Thank you for bringing that up. I'll see if we come back to that. It's one of those not absolutely necessary, but it's kind of fun, and I can spend a little bit of time on it. So remind me if we get back there. Okay, so here's our potential loss. And so what would we need to do to hedge that loss? What would we need to do to hedge the loss? So what is hedging in general? I think we defined it last time. What do you got in your notes? What is a hedge?
A financial transaction that affects a long-term position with some sort of short position or vice versa.
Okay, so we've got a long position. So what do we need to do to hedge? Take a short position. How much? Yeah, we need to get this 960 off the books. So we can take a position to offset that loss so that we're made whole. All right, so if we take a short position, take a short in the futures contract, of 4,039,640, which is the value of the 5 million. And then we've got the answer. So the key point is that the buyer of that financial instrument agreed to pay you $5 million. So now the loss is going to be theirs. So the buyer of that contract agreed to pay you $5 million. And you have the goods to deliver to them, right? You're going to deliver, you're going to fulfill the future, you're going to give them the bonds, and they're going to pay you $5 million, even though the market value today is only $4. Okay, questions on that? Similar to our apple pie thing, in a sense, but we did it with this interest rate risk. So it's really just a slight variation of handling pricing in an interest rate environment as opposed to in a physical goods environment. Okay. Yes, questions? Let me pause. I don't want to move too fast. All right. There's with hedging, there's a little formula that is kind of helpful. Remember that with the futures, how did the futures contracts vary from the forward contract? What were some of the ways that it varied? Conceptually, it was kind of the same thing, but it varied in a few specific ways. Futures versus forward contract. What's that? What had a lack of liquidity? The future or the forward? The forward did, okay? And so how did we overcome that a little bit with the futures market? What made it more liquidable? Smaller shares, that was one thing. So this is what this next thing kind of looks at, is the number of contracts that you need. So, so you can use a simple formula to calculate the number of contracts needed, the number of contracts, which we're going to use NC, the number of contracts, the number of contracts needed for a hedge. And it's pretty simple. The value of an asset, so the value of the asset divided by the value of the contracts. The contracts are standardized. So the value of the asset divided by the value of the contract gives you the number of contracts you need. I'm going to show a slide here in a second, but the value of the contract is standardized. And that's what kind of helps us remember what we're really doing. So if you have a $5 million hedge that you need to do, but the contracts are all in $100,000 increments, you just take $5 million divided by the 100,000, and that'll tell you the number of contracts. Okay? So, example. If you have a $5 million hedge and $100,000 contracts, futures contracts, then the number of contracts needed is our 5 million divided by our 100,000 gives us 50 contracts. So in this case, you need to sell 50 treasury bond futures. Okay, good on that? One little quickie thing, little lingo. There's a difference between a micro hedge and a macro hedge. So a micro hedge is something you do on a specific asset if you're trying something. So you use this for a specific asset. Kind of like what the problem we just showed. We had these long-term bonds. That would be a micro hedge. A macro hedge is some sort of purchase and sale for the portfolio. So we might be doing multiple things in different types of financial assets, looking at our overall portfolio where we have thousands of financial assets, and we're trying to take a position to limit the downward risk in a bull market or something. We might be doing some stuff to kind of watch the portfolio. And so they call that a macro hedge. Okay, let's take a quick look at these contracts. This is just one straight out of your PowerPoints from your textbook. I'm just going to put this on. Okay, so the book here just put in widely held traded futures. So the Chicago Board of Trade usually does these. So we've got all kinds of interest rate contracts for treasury bonds, treasury notes, so longer term, longer than a year, 3-month bonds, all of those US government stuff is all frequently traded. So the contract size varies. You can see your mom and pop shop if you're buying some futures contracts, so minimum amount 100,000, and then up to $5 million contracts, euro dollars. And then on the stock indices, so we got S&P 500, the mid cap, NASDAQ, Nikkei index, and then all the currency contracts. So currency is especially useful for our global economy, so that if you've got a deal going down with somebody in China, you can do some maneuvers in the currency contracts to get rid of that risk. Because a lot of times the companies, they're not in it to take risk on in the foreign exchange market. And so they'll come in and do these types of contracts to minimize their exchange rate risk. Okay, good on that? I just wanted to give you kind of a snapshot, yeah.
This is the right side column.
Open interest, so this is the number of contracts that were out there. So it's kind of like the volume. And that was back in May, just to give you an idea of the different types of volume of each one of these instruments. So it's open when we're during the time frame, like that one we just did between May 13th or whatever, March 13th and March of 2014. During that time frame, it's open. So there's one of those contracts that are open during that time frame. And then those people can go and sell that or buy that or trade that at any time during the open period. So it's given us an idea of the volume out there. Okay, anything else? So based on the performance of the S&P, you can bet whether it's going to go up or down. And so if you have a mutual fund, I'll just use it as a personal investment. Let's say you have a mutual fund that's worth $1 million for retirement. And you're like, oh man, that'd be great, but if another financial crisis hits, if I'm looking to retire tomorrow, I don't want that thing going in the crap run. And so I could engage in one of these contracts to hedge that risk. Right? So if your portfolio, and you can also use these to offset general market risk too, in kind of that macro hedge. Anything else? Okay, so We get to talk about options next. So futures and forwards are actual promises to deliver. An option is similar in that we're dealing with the value in the future. So the value of the option is derived from the value of the underlying asset in the future, right? So we're still talking in this derivative concept. And so let's start with a few definitions here. So option contracts. How about a call option? Call option, right to buy or right to sell? Right to buy. So if you're called, the call option is I can call to buy that. I don't know, however you want to memorize it, but call option gives the owner the right to buy. Gives the owner of the option the right to buy. A financial instrument at the exercise price within a specified period of time. So this ends up putting together the pieces of the puzzle. Gives the owner of the option the right to buy a financial instrument at the exercise price within a specified period of time. And a put option is just the opposite. So it gives owner the right to sell, ... The rest of the definition is all the same. So with the call, it's the right to buy, and with put, it's the right to sell. All right, so I'm going to start my graphs and see if I can do it a little better today than I did there. All right, so suppose we got company ABC, ABCD, and the current stock price is 50. Current price equals $50 a share. And then we have the call option price equal to $5 with a strike price, which is the exercise price, at C. And an expiration of 1 month from now. So for the next month, that's our deal. We can have the right to buy for $5 as long as it hits the $60 mark. All right, so what does this thing look like? So we'll measure time on the vertical axis. We have the stock. Let's first of all do, I don't know, 10, 20, 30, 40, 50, 60, 70, 80. And then here is now. And over time, you know that currently it's at 50, and then who knows? It's just done something over time. It's got some sort of ticker tape going up to right now. Okay, so with a call option, are we hoping it continues to go up, or are we hoping it goes down? With a call option, are we hoping the sucker goes up, or hope it goes down? Up. Right, so with a call option, if that's what we're doing, we hope it goes up. So let's look at a couple possible outcomes in the future. So this is 1 month from now in the future. And let's have it go up to 80 and call that outcome A. So one possibility is that if we had a crystal ball, this thing goes up to A. Or it falls to 20. Situation B. And I should have used red instead. Oh, we have 4 choice of colors. Red might have been good for the fall. That's just like. Okay, so now I want to go through kind of the various scenarios of how we would do under different options of buying this thing. So what if we just took a good old long position? If we took a long position and we ended up at outcome A, how much money would we make? So if we took a long position and the world turned out to be outcome A, what would we make? Not a trick question. Be brave. 30 bucks, right? So we buy at 50. A good old buy low, sell high, right? I'm going to take a long position, buy at 50, hope to make some money at 80. So for that case, if we have an end price of 80 and we had a long position, then our profit is just the 80 minus 50, we're up 30 bucks. Why? Because we put $50 down, we put in 50, put 50 down, and got 80. Just to make crystal clear how we're making our money on a long position. So with the option, how much money would we make if outcome A happened? Suppose we took out an option. So I have now the right to buy. I've got the right to buy the stock at the exercise price, which is the strike price. I'm just going to put that up there. Exercise, same thing. $20. Close, 15, because we got the option price to begin with. So yes, you're going to end up buying it for 60, selling it for 80, basically instantaneously that day. but you also paid $5 for the right to do that. So your profit at the end of the day ends up being 80 minus 60 minus 5. So I make 15. Now, which one's a better rate of return between my long position and my option? So I made $30. How much did I put at risk? How much did I put down? 50. So I put $50 down and I made 30. Here I put $5 down and made and got 15. Not a bad deal, right? So kind of almost tripling our money with the option arrangement. Now, I think the fair thing to say would be, if the stock really plummeted, would it go all the way to zero in a month? Probably not, right? I mean, you take financial crisis style, it's probably not going to fall all the way to there. So that would be fair to kind of put into the analysis. But nonetheless, you kind of get the different feel for it. All right, so what now if we took the bad outcome B? Suppose we ended up at $20. What does our long position look like? Down, we're down 30. So we're down 30 on the long, and what are we out with the option? What are we out with the option? $5. We wouldn't, there's nothing to exercise. You just have the right to buy it, but you don't have to buy it. So you've got the right to buy it, but you don't have to buy it. So you're just down 5. So in this situation, you put in 5 and you lost 5. Here you put in 50 and you lost 30, right? So we kind of got some differences going on with the option. All right, so questions on that? So what happens if you think ABC company is going to most likely go down? What should we do differently? Take a short. So we can short the company overall, or what else can we do now? So we can take a short position or the put. So it's just the opposite of what we have over here. Now we'll have the right to sell it instead of the right to buy it. So we've got those two options. So note, if you think ABC D will fall, go short. Take a short position, either on a contract, put option, or a either on a put option or in a short position for the stock. So with the short position, we did this that other time. Remember, we're essentially going to borrow the stock, almost like renting it from our broker. Is fundamentally kind of how it works. So we're going to borrow it, and then we're going to sell it for 50. Put that in quotes, and buy it back for 20. Buy it back for 20, return it to the owner, return the shares back to the owner, and you're going to pocket the $30. So the broker has kind of the control of this. They allow these deals to be done where you're going to effectively rent it. It was actually in the fine print for the person who owned it that they would allow this to happen. The broker would always just buy it back if somebody wanted to sell it. So this is all kind of a little bit of focus of a shell game going on with the dealer. But you're going to borrow it, sell it, and then buy it back later. And that's how you're going to make your money. Questions on that? That was a little bit of review from last time from the sell position. All right. So what happens if it goes up? If stock increases, rises to 80, what happens? If you take that short position, what happens then? You're going to lose 30. So just the opposite. You're going to have to go to the market. You sold it. Now you have to buy it back by contract, and you're going to have to buy it back at 80, and you're going to lose your 30. So you're going to rises to 80. So you sell at 50, buy at 80, and lose 30 bucks. Now, this is where fundamentally a short position can be very different from a long position. In a long position, if you put in 50, what's the most you're going to lose? 50. If the stock goes all the way to 0, which I've had some of mine do on the first stocks I ever bought, but basically went to 0, you lose everything, right? You lose 50. In a short position, how bad could it get? If this stock blows up to $800 per share, you lose $750, a lot. So this has no upper bound like you do with the lower bound on a long position. In a long position, 0 is your worst outcome. In a short position, it's potentially infinity. And so some big investors have gambled close to infinity on really risky assets, thinking something's going to go, and they have to make good on their short position. So that's kind of an important note here. So note, if stock goes to 800 or more, you lose your shorts. Lose a lot. So oftentimes, smaller investors tend to avoid short positions. So I've heard multiple people who are kind of in the business that if you can play a short position well, a lot of people stay away from them because of this fear of loss, and that there's oftentimes money to be made in the short position. But it can be a little scary. All right, so let me summarize all of these. Now we got a little better idea of the big short. All right, so end price. I'm just going to summarize everything. So at $80 or at $50, $20, and we had our long position. We made 30. We lost 30. With our call option, we made 15. We lost our call price. Lost 5. With our short position, we would lose 30 or gain 30. And then our put option would be just the opposite of the call. We lose 5, we gain 15. Yeah.
Since recently the Snapchat went public, like going up and going down.
Yep.
Do you think a lot of people, investors do some of that stuff?
Yep. I don't know what the volume of trade is. I didn't look at it, but I'm guessing there was a lot of people shorting. I would have been shorting if I would have been in on it. I didn't think it was very strong to begin with. I'm not that bold on it. I wouldn't have put too much money, but I would have been willing to pay at least $100. Right now, like when the stock was up to 24, just kind of thinking about the situation, I think that was a pretty good bet that it was going to come down. I would have put $100 on that all day long. And then that's where you put it. If you put the $100 on the option, then that would have bought us what, 20 options. We would have made 20 times 15, right? So you can leverage yourself higher. If you think about it on how much you want to put money into, you can make a lot more playing the options market rather than taking a short position, a true short position. You can do it with less money. If the put option was only $5, then I could turn my $100 into whatever 20 times 15. What is that? $300. So I triple my money, and then at most I lose 100. So it kind of changes the game a little bit on what you're doing in terms of the upward potential. Now the other thing is it has to get to the strike price though. So in that case, what was it the day we turned it up? Wasn't it $4? And so I didn't look at, I have no idea what the options were, but it would have had to fall to X amount, whatever X amount is, $20 for me to be in the money or out of the money, which I haven't talked about yet. But in order for that to be something I can execute on, I'd have to fall down to the exercise price. So it's not good enough for it just to fall. Oh, McCullough, you were right, it did fall, but it only fell to 21. Damn, I needed it to fall to 20 to be tripling my money, right? So there's that little element of risk that way too. Okay, anything else? All right, so a couple options to define here. There's an American option and the European option. Okay, so two types of options. The American option, put or call, this can be exercised anytime up to the expiration date. European options have to go the whole way. Can only be exercised on the expiration date. So in the United States, we tend to have the American option. Most of them are that. So as we're coming through time here, we can choose to exercise early. So we can sell that option at 70 and take the 70 minus the 60 difference. If you kind of want to chicken out, you're not sure where it's going to go. Because remember, it's possible that once it breaks 60, like it did here, I guess, with my graph almost. It broke 60, but then it dropped back down. So there's still risk as you go. So the American option allows you to exercise it at any time, whether it's put or call, and the European option goes all the way to the end. Let's see what this thing, last thing we're going to end with here is just a graph of what this thing looks like. This is in your textbook. So here is a futures contract. Here is the buyer of a option, call option. And so the option price was $2,000. So if the price of the stock stays below 115, in this case, you got to get up to here to get the option price out of there. But on a futures contract, if it stays below 115, then the person's going to be losing money according to where the vertical height here is on the price. If it's at 110, then they lost this amount. But if the person with the call option, the most they're going to lose is their option price. So if it falls to 110, they're going to just lose the $2,000. And then eventually you reach this threshold where you're going to be making a profit on the option as long as the price is higher than this. If you bought the futures contract, you're already in the money here on the future. And so this line, the blue line, shows the futures price all the way up, and the red line shows the option. And then the same is true for the put side, where you've got a futures contract here with your position. If the stock goes down, so you have a short position, futures contract price goes up, you make some money. And likewise, if it falls, if it gets higher, the most you're going to lose is your option amount. Okay, so that's just a quick snippet of that. We'll call it a day there. See ya on Wednesday. And then we'll hit interest rate swaps, another fun one.